I'm Roger Baker, Executive Director of the Stratfor Center for Applied Geopolitics at RANE, a global center of excellence for geopolitical intelligence and analysis. Learn how you can put geopolitics to work for your organization at ranenetwork.com.
Welcome to RANE's Essential Geopolitics podcast. I'm Ryan Bohl, a senior Middle East and North Africa analyst here at the RANE Network. Here with me today is Matteo Ilardo, our European analyst. Thanks for joining me, Matteo.
Hi, Ryan. Thank you for having me.
So today we were going to talk about EU sanctions against Russia's oil exports. And EU sanctions against Russian oil exports oil products took effect last Sunday, with the bloc putting an embargo on gasoline, diesel, and other refined products coming from the Russian Federation. As the EU normally imports most of its diesel from Russia, this is a major development for the market. But what impact will these sanctions ultimately have? So, Matteo, let's start off with what is the new ban targeting exactly, and how does it work?
So the ban targets all refined oil products from Russia. Basically, everything that you can take out of a barrel of crude oil. This includes lighter products like naphtha and gasoline, middle distillates like jet fuel, gas oil, and diesel, and heavier products like fuel oil that is usually used in ships, for instance. The ban here, just like it was the one in December against seaborne crude oil imports from Russia, was accompanied by a price cap. The idea behind it being to reduce Russia's oil revenues without disrupting global energy markets as a whole. In fact, the price cap effectively works as a sort of amendment to the embargo. It allows ships owned and insured by companies based in either the EU or G7 countries, because the price cap is an EU G7 initiative. So basically EU plus Canada, US, UK, and Japan. It allows them to trade the Russian refined products if this is done below a certain price threshold, which was set in this case at $100 per barrel for premium refined products. So we're talking about products that sell at a premium on crude oil, so gasoline, diesel, jet fuel, and at $45 per barrel of products like fuel oil, naphtha, and other those products basically that trade at a discount to crude oil. So now this is going to be very important for particularly for diesel, for naphtha as well, but mostly for diesel, as Russia was, as you said, Ryan, by far the dominant non-European supplier of diesel to Europe, providing something like a third of total diesel imports in 2022. Because of this, many, including me, were expecting a significantly bigger impact that we are currently seeing in the market. So the impact, in fact, doesn't really seem that substantial for now, neither in terms of reduction in output from Russia nor in terms of supplies to Europe, and not even in terms of market prices. So this is due to several factors, mostly the fact that Europe managed to increase stockpiles of diesel significantly before the ban entered into force. European buyers were well aware of this, that this was coming months ago, so had time to prepare, and in general other market forces that are keeping prices low for now. But most importantly, beyond prices, this is not creating the shortages that many had feared could happen before the cap entered into force on Sunday.
So I think you're saying that for now is probably the most important part, but we do have a large volume of oil products coming off the market, and there's got to be somebody who's going to be trying to fill that gap. And what does that mean as somebody attempts to fill that gap for prices in Europe and beyond?
Yeah, no, you're right, Ryan. We're seeing indeed a bit of a reshuffle in global supplies to readjust to the ban and basically get those missing barrels to Europe that are not coming from Russia anymore. So if we're not seeing a great disruption so far, we still definitely are seeing a great transformation within the market. We saw Europe increased imports from mostly from the US, but also a lot from the Middle East and part of Asia. It did so already months ago. It's continuing to do so. Imports are increasing now from those regions. For instance, at the end of 2022, at the end of last year, Qatar announced in 2023 it would have increased fivefold the supplies of diesel to Europe. Saudi Arabia said also it would increase outputs from its refineries of diesel to Europe. Americans refiners started shifting production towards increasing output of diesel to gain on to profit on higher margins for the product, because diesel prices have been significantly higher than other oil products throughout last year. Looking ahead, the Middle East again should be still relatively well placed to basically plug the supply gap in Europe for diesel, thanks to the proximity and also for new refineries coming online, and the US as well, because diesel cracks, which is how the industry calls the margin in between the raw, the crude oil and the diesel, the refined products, are set to remain high, even though prices have not spiked after the price cap. The impact of prices for now has been limited, and this was due to several factors. The fact that, for instance, markets, as I said earlier, had a lot of time to prepare and adjust to find alternative suppliers. We had strong stockpiles built in Europe, and this was because European buyers accelerated purchases of Russian diesel prior to the beginning of the ban. This was particularly evident in November, December, but also last month, where they were on average, if I'm not wrong, 700,000 barrel per day imported in the month, so above average, exactly in preparation of this ban. So the market found itself ready for this ban, and but at the same time, as we were saying earlier, this is the impact so far. We could see, and maybe we'll talk about that a bit later, but we'll see how rerouting exports, both for Europe's new suppliers and for Russia, will have an impact on global prices. And we may see the full effect of the ban in the next months. Another reason why prices for now are falling is that we are in the middle of a recession in most of advanced economies, and diesel is very closely tied, the price of diesel, to the general health of the economy, because diesel normally powers industry, and powers not only because it is becoming it is also a source of heating in industry, a source of power in industry, particularly because of high gas prices in Europe, but it also powers business fleets, basically light trucks, heavy trucks that delivers goods around the economy. So the price of diesel goes hand in hand with the macroeconomic situation of a country. Once that is over, we are expecting the recession currently to be short-lived. So once the economy goes back in shape, then diesel prices are set to increase again. And once Chinese demand also comes back online, we may see volumes that normally China exports to the rest of the world being left increasingly to the domestic market. So we may see the market getting a bit tighter and prices increasing over time.
So we're thinking a lot about the impact of Europe cutting off the Russians, but what happens to Moscow itself? Where will it sell its oil products, and how will its economy be affected?
So Russia obviously opposes any attempts to cap prices of its energy exports. In December, it had banned crude sales to those buyers that mention even indirectly the price ceiling in their contracts, and it has done something just like that now in response to the ban to oil products. So keeping that in mind, where it is selling to mostly historic markets, for instance, to Turkey. It has increased significantly its supplies there. It is selling in Africa, North African countries in particular, which is also very something to keep in mind, because we may see some of those countries blending in Russian diesel with their own and then selling it back to Europe, and basically have Russian diesel that comes in the region anyways, just with a different name and a bit of a different taste because of the blend. But so that's also something to keep in mind. But mostly also it's rerouting it to African countries, other countries in Asia and the Middle East. And it's also not for now, but may start selling more diesel to Latin American countries, trying to pull the plug into the supplies there once, as the US increases volumes of diesels to Europe, which normally would go to Latin America. So literally we have supplies shifting in this sense. Russian diesel going to Latin America, US diesel going to Europe. And this, of course, has an impact on prices, because longer routes mean also lower margins, increased shipping costs. And definitely that will reflect eventually on global prices.
Certainly a lot to think about, and a very big topic that we will continue to track throughout the year of 2023. Thank you, Matteo, for joining me. Understanding geopolitics is critical to future planning, whether you run a multinational conglomerate or you are planning a trip to a place you've never been. RANE offers businesses complete geopolitical intelligence solution with worldview for enterprises. Our app delivers forward-looking, enterprise-level analysis and tools that enhance your ability to understand what happens next. Learn more about RANE's geopolitical intelligence solution at ranenetwork.com. That's RANE network.com. Thanks again, Matteo, for joining us and discussing this important issue.
Thank you, Ryan.
I'm Ryan Bolt. Thanks for listening.